And I think every company that trades is always thinking about growth, new innovation, new service, new whatever it might be. And so companies on average do grow every year. And so an index fund, a passive fund, you can participate in that at very low cost, and it's easy to do. If you have the time to spend on analyzing companies, which takes a lot of time, you may want to pay for the service, which would be active managed funds. Me, for the average guy, I think passive funds, we started a fund in 1991, Schwab 1000, it's averaged about 9.9% compounded growth rate, compounded for all those years since 91.
Imagine transforming $50,000 into a staggering $1 million portfolio. Sounds like a dream? With Charles Schwab's SCHD, this could be your reality. Today, we're looking into how an initial investment of $50,000, $100,000, $150,000, or even $200,000 in the Schwab U.S. Dividend Equity ETF could grow into a seven-figure sum. We'll explore the power of dividends, the magic of compounding, and exactly how long it might take to reach that highly desirable millionaire status with SCHD. Let's do the math and figure out how long the different levels of investment in SCHD will take to grow. If you're looking to turn a sizable investment into a fortune, understanding what SCHD is and how it operates is your first step. This isn't just any ETF. It's a gateway to some of the most reliable dividend-paying stocks in the U.S. market. Launched back in 2011, SCHD has been a solid choice for investors aiming for both income and growth. Now let's break down what makes SCHD stand out. It focuses on high-yield dividend stocks, but not just any stocks. SCHD carefully selects companies that have a history of paying dividends consistently for at least 10 years. This isn't about catching the latest market trend, it's about stability and reliability. These companies are usually leaders in their industries, have stood the test of time, and have demonstrated financial health across market cycles. The ETF currently holds around 100 companies, but it's not about the number, it's about the quality. Each company within the ETF has not only maintained, but has often increased its dividends over the years. This signals strong financial management and a commitment to shareholder returns. Investing in SCHD means you're investing in companies like Pfizer, Chevron, and Coca-Cola, household names known for their enduring business models and consistent performance. What's equally impressive about SCHD is its low expense ratio. At just 0.06%, it's one of the most cost-effective ways to gain exposure to a diversified portfolio of dividend stocks. This low cost ensures that more of your money is working for you, rather than getting eaten up by fees. Over time, this can make a significant difference in your investment growth. Moreover, SCHD's approach isn't just about picking any high dividend stock. It follows a rigorous methodology to select stocks that are financially healthy, have a high yield, and show potential for continued growth. The ETF screens for factors like return on equity and 5-year dividend growth rate, ensuring that its holdings aren't just safe bets, but are also poised for future growth. This methodical approach has paid off. Over the past decade, SCHD has shown a commendable performance, consistently beating many of its peers in the dividend ETF space. It's not just about returns, though. SCHD provides a cushion against market volatility, thanks to its focus on large, established companies that are less susceptible to large market swings. If you're planning to grow your investment from $50,000 to even $1 million, understanding and leveraging the stability and strategic construction of SCHD could be your key to success.
You know, we joined the New York Exchange in 1981, many years ago, and so prices then, when we first came on board, we were about half price. We kept coming down every year to now. It was sort of the final solution for investors. We have a great deal for investors.
Investing in SCHD isn't just about adding another ETF to your portfolio. It's about making a strategic decision that aligns with long-term financial stability and growth. Why choose SCHD among the extensive number of options available? The answer lies in its unique combination of safety, income, and growth potential, specifically designed for investors who are planning for the future. Firstly, let's talk about diversification. SCHD provides an excellent avenue for spreading investment risks. Unlike investing directly in single stocks, where your fortune rises and falls with one company, SCHD spreads your investment across a basket of hand-picked dividend stocks. This spread includes top-tier companies across various sectors like technology, healthcare, and consumer goods, providing a balanced mix that can weather different economic conditions. This structure significantly mitigates the risks associated with market volatility and sector-specific downturns. Another compelling reason to invest in SCHD is its focus on recession-resistant stocks. The ETF is filled with companies that have a proven track record of performing well even during economic downturns. These companies are often in industries that provide essential services, healthcare, utilities, and consumer products that people need regardless of the economic climate. This resilience makes SCHD an attractive option for those who seek stability in uncertain times. Moreover, SCHD's inflation-protective characteristics are of the utmost performance in preserving your capital's purchasing power. Many of the companies within SCHD have strong pricing power, meaning they can adjust their prices in response to inflation without losing customers. This ability is a key factor in maintaining steady revenue streams and, by extension, stable dividends. Hence, investing in SCHD can provide a hedge against inflation, a rare quality that can safeguard your investments as the cost of living increases. Finally, the performance of SCHD speaks for itself. It's not merely about steady dividends. The ETF has also exhibited commendable capital appreciation over the years. This dual benefit of income plus growth is what makes SCHD a standout in the crowded market of dividend-focused funds. By consistently delivering returns through thick and thin, SCHD has proved to be a reliable vehicle for growing wealth over time. Charles Schwab has wisely pointed out, "I consider every client important. They know they can depend on us to be there when they need us most." This statement reflects the core values behind SCHD: reliability and client-focused investment. It's designed not just to attract, but to retain savvy investors by meeting their expectations and financial goals. Its strategic selection of stocks, combined with a focus on long-term stability and growth, makes it an ideal choice for anyone looking to transform their initial investments into significant wealth. Whether you start with $50,000 or $200,000, SCHD offers a path to reaching your financial objectives with confidence and peace of mind. Investing in SCHD means placing your trust in a fund that boasts an impressive track record for both stability and performance. Let's look at the numbers to understand why SCHD is considered a solid choice for those aiming to grow their wealth consistently and securely. Since its inception in 2011, SCHD has delivered a commendable annualized return, consistently outperforming many of its peers in the dividend ETF arena. The fund's emphasis on high-quality dividend growth stocks has paid off, particularly in terms of total returns, which include both capital appreciation and dividend payments. For example, over the past decade, SCHD has achieved an average annual return of approximately 10 to 12%, which is quite solid given the volatility in the market during this period. What makes SCHD particularly appealing is its low volatility compared to broader stock market. During significant market downturns, such as the one experienced in 2020, SCHD's losses were considerably less severe than those of the S&P 500. Specifically, while the S&P 500 dipped by about 34% at its lowest point, SCHD's maximum drawdown was closer to 25%. This reduced volatility is critical for long-term investment strategies, as it helps preserve capital during downturns, setting a smoother path for growth in favorable conditions. Additionally, SCHD's dividend yield has been consistently higher than the average yield offered by the S&P 500. As of last year, SCHD offered a dividend yield of around 3.5% compared to the S&P 500's yield of approximately 1.5%. This higher yield not only provides a steady income stream, but also contributes significantly to the total returns, enhancing the compounding effect when dividends are reinvested. The ETF's performance isn't just about the numbers, it's also about the quality of its holdings. SCHD manages a portfolio of some of the strongest American companies financially. These companies have a long history of not only paying dividends, but also raising them. For example, over the past 5 years, the average dividend growth rate among SCHD's holdings has been around 7% per annum, illustrating the fund's strategy to invest in companies with growing rather than static dividend payouts. For an investor starting with $50,000, these factors, consistent performance, lower volatility, and a strong focus on dividend growth, makes SCHD a compelling vehicle for aiming towards a $1 million portfolio. This combination of steady income and potential for capital appreciation, supported by a history of solid numbers, shows SCHD's suitability for long-term wealth building. We'll consider starting investments of $50,000, $100,000, $150K, and $200,000, integrating both the growth in the value of the ETF and dividends that increase over time. For our simulations, we'll use an average annual capital appreciation of 7% based on SCHD's historical performance trends. Additionally, we'll start with an initial dividend yield of 3.5% and factor in an estimated annual growth rate of 5% for the dividends, reflecting SCHD's focus on companies with a history of increasing their payouts. Imagine you invest $50,000 in SCHD. In the first year, your investment could earn a 7% increase due to capital appreciation, which would increase your investment by $3,500. Additionally, you would receive a dividend of 3.5% on your initial investment, which adds another $1,750 to your returns. These dividends are not just sitting there, they are reinvested, which means the total gains for the year, including dividends, amount to $5,250. This is reinvested back into SCHD, increasing your total investment to $55,250 at the end of the first year. As the years pass by, this process continues, with each year's gains adding to the principal amount, which then generates its own gains through appreciation and dividends. Moreover, as dividends grow annually by 5%, their contribution to your total portfolio increases, accelerating your total returns thanks to the power of compounding. Let's project this further. By the end of the 10th year, thanks to the compounded growth of both the capital and reinvested dividends, which have been increasing, your initial investment could have grown significantly, potentially nearing double your initial amount. To reach the $1 million mark, given the initial amount and the compounding effect of increasing dividends, you might expect to hit this goal around the 30th year. This simulation provides a snapshot using just the $50,000 initial investment. After exploring how an investment of $50,000 could evolve with SCHD, let's look into the impact of larger initial investments on accelerating your journey to $1 million. We continue using the same assumptions, a 7% annual capital appreciation and an initial dividend yield of 3.5%, which increases by 5% each year. When you begin with $100,000, the compounded effects of capital appreciation and reinvested dividends work more robustly in your favor. In the first year, a 7% appreciation would increase your portfolio by $7,000. Additionally, you'd receive dividends amounting to $3,500. Combining your capital gains and dividends, you'd see a total growth of $10,500 for the year. Reinvesting this amount brings your total to $110,500. Over time, as this process repeats annually, both the value of your investment and the dividends grow due to the reinvestment and the annual increase in dividend yield. By the 10th year, your portfolio would potentially approach or exceed $200,000. You could hit the $1 million mark by around the 24th year, significantly faster than starting with $50,000. Initializing your investment with $150,000 makes the timeline to reach significant financial milestones even shorter. In your first year alone, a 7% appreciation contributes an additional $10,500 to your portfolio, coupled with $5,250 from dividends. This brings your year-end total increase to $15,750. And after reinvestment, your new total would be $165,750. As with the previous scenario, your dividends and capital appreciation compound annually. After 10 years, your investment could grow considerably beyond the $300,000 mark, potentially reaching $1 million around the 20th year. The scenario with the highest initial investment of $200,000 offers the quickest path to reaching $1 million. With a 7% return, you'd gain $14,000 in appreciation, along with $7,000 from dividends in the first year alone. A combined growth of $21,000 when reinvested raises your total to $221,000 by the end of the first year. The substantial base amount further amplifies the effects of compounding, accelerating the growth of your portfolio. By the 10th year, you could see your investments swell to well over $400,000. You might reach the $1 million milestone as early as around the 17th year. These simulations clearly illustrate the powerful effect of starting with larger amounts in a stable and strong fund like SCHD. The strategic investment of dividends, coupled with consistent capital appreciation, significantly shortens the time required to reach $1 million, demonstrating the practical benefits of compound interest and sound investment choices. By starting with a more substantial amount, you can achieve your financial goals much sooner, leveraging the steady performance and reliability of SCHD to build a secure financial future. So what do you think? Are you ready to watch your money grow with SCHD? How much would you consider investing to start your journey towards $1 million? SCHD from Charles Schwab lets you invest in a smart, strategic way. Let your money work as hard as you do. If you want to know more about investing in SCHD, please like, subscribe, and leave a comment below.